So here's the course website. Go down. The technical analyst. There's your pre-test stuff right there. And here's the Excel spreadsheet. So, Zoreen, what's your role? Okay, you're the technical securities analyst. Who's your portfolio manager? Okay, so right here where it says stock portfolio. Okay, click on it. Albert, how far along are you?
We have all of our stocks, we have all of our weights. We just need to enter in stock prices and assets.
Okay. Once you get it all in, then show it to me so I can check it. Albert, what's your portfolio style?
Heavy on the tech sector with the rest of the portfolio balanced between health, consumer goods, and financials.
Okay. And Jack, what's your portfolio strategy?
We're still working on that, but
Okay, you got to have a strategy by like today or Thursday. You have 3 weeks to come up with it. Okay. What are you selling? Why are we here? Right? I mean, what's our goal?
make money.
Exactly. Okay. And how do we make money?
Make a product.
In this, we make a product. Exactly. And how do you sell a product? It has to have what? Well, how do you create value in a product? It's got to have what? Think about your marketing class.
Good sales pitch.
Well, no, because, well, in your sales pitch, what are you selling? Come on, finance people are marketing people. I mean, if you don't know that yet, finance is just a technology to basically develop product and process that we're going to sell our clients. So basically, we're in the product development business. So how do you sell a product? What does the product have to have? What? What?
Differentiation.
Yeah, you have product attributes, right? So you're selling a portfolio, you're selling financial products with product attributes to do what? What are products supposed to do?
Supposed to fix a problem.
Yeah, exactly. They're supposed to solve a problem. What's the problem that we're solving here in the construction of this portfolio? What problem are we solving? What are we solving? I'm building a portfolio to then sell the strategy to investors. And what's the problem for investors? What's the problem that we're solving?
They need more money.
They need more money to do what? No, what are they trying to solve for? Particularly retail investors. Guys like you and me, your parents, your grandparents.
Retirement.
Yeah, exactly. They're trying to accumulate capital so that they can retire and not run out of money and be thrown on the streets. So we're building basically financial products that are going to give them the opportunity, the vehicle, to be able to accumulate wealth over their retirement, over their working years, to then be able to use and save at some point in time and liquidate the portfolio slowly over time to be able to live off of for the rest of their life. Okay, that's what we're doing. Okay, is we're building products with product attributes. You have to tell me what it is you're building. Now, what are you building again? What kind of portfolio are you building?
A portfolio that can return more than the S&P 500.
Okay, well, he's building a portfolio that's going to have an alpha, of course, right? Because if we're going to actively manage these portfolios, we got to generate an alpha, because if we don't, why won't they just buy the S&P 500 ETF and just tell us to go hit the skids and not pay us any fees? Okay, so if we can't compete and beat the S&P 500, we're out of business. So what's the other sales pitch? So obviously there's the alpha. How are you going to drive alpha in your portfolio? What's the strategy? What's the portfolio? You guys should be writing notes instead of just sitting there And I think I've been asking you to write notes every time I start the lecture so that you can, use your notes to be able to do the tasks that you need to do. So how's your portfolio gonna generate alpha? How are you gonna beat the benchmark? What's the portfolio attributes? How are you gonna beat the benchmark? Oh, I'm just gonna pick stocks randomly and hope that they outperform the S&P 500.
Minimize risk and maximize return.
Diversify.
Yeah, well, those are all generalizations, but give me some specifics on how you're designing. Could you even Google and go online and say portfolio construction process, portfolio style, go look at some ETFs and mutual funds that have been designed by a plethora of companies and look at what their marketing pitches are to get an idea of what your portfolio construction process should look like and how you're gonna sell me in the investment committee to give you the money to basically build the product, and then we'll distribute it through our distribution channels, just like Franklin and Vanguard and Schwab and JP Morgan, Goldman Sachs, Citigroup, you name it, they all do the same thing. We're talking about a multi-trillion-dollar industry. If you can build product and consistently build product consistently over time and deliver it to the market, you're gonna be a trillion-dollar or multi-trillion-dollar company just like BlackRock, okay? That's what we're trying to do here, all right? We're not playing around, we're actually doing real stuff, okay? So how are you gonna generate alpha? How are you generating alpha? Because saying I generate alpha is nebulous unless you can defend yourself. And give me the portfolio attributes and the portfolio style that's gonna convince me that yes, okay, I totally get what you're saying, show me the back test, particularly the 10-year performance. So how are you gonna generate alpha?
By diversifying.
That's a general term. And you don't generate alpha through
By
diversification.
diversifying to lower your risk.
Those are general terms.
Investing in parts of the industry that are gonna be growing in the future.
Give me specifics.
So like one thing we were talking about is energy.
Okay, we are gonna, one of our sectors is energy.
Correct.
I'm helping you with the language.
Our main sector is gonna be energy.
Excellent. And do you have any other sectors that you're gonna be investing in?
Healthcare,
Excellent.
real estate,
Got it.
and tech.
Okay, excellent. Do you know the proportions yet?
We're gonna try to,
Or we are?
we're going to
No,
be heavy.
we are heavy.
We're, okay.
Okay, no past tense, you guys. In the real world, it's all in language. If you're past tense, that means you're apprehensive. If it's current tense, and this is what we're doing right now. Okay, go ahead.
Yeah,
You're
so
doing
right,
good.
Right now, we're 50% heavy on energy, and then equally distributed between tech, healthcare, and real estate.
That was beautiful. What sectors of the energy? Are you doing carbon or carbon-free? Or you doing alternative? Renewables?
Solar, wind,
Okay, so it's gonna be more renewable?
correct.
Okay, excellent. I'd love to see the back test on that. Okay, anybody else? Come on, I need to hear this. It's 3 weeks in. I got, at least by now, we should have portfolio strategies done.
For our portfolio, we are heavy in the tech sector due to the tech sector's recent growth. We are 40% in the tech sector, diversified 20% in health, 20% in financials, and 20% in consumer goods.
Excellent. So I totally know the risk-return trade-off associated with that now within my brain because you did the pitch. I know exactly what the expected returns are and what the volatility will be associated with that portfolio. Now show me the back test so I can see if the results and see if it's going to work. The attribution in your returns, the ability to beat the market through alpha is in your sector allocations and your stock picking. Okay, sector allocation and stock picking. Okay, next. Who else? I probably have like 10 teams in here, or at least 9 teams in here.
Our portfolio is heavy on tech. We'd say our portfolio is heavy on tech 40%, and then equally distributed across food and beverage and manufacturing and clothing.
Okay, excellent. So you have some defensives in there and you're taking advantage of the volatility and the growth in the tech sector.
Yes.
Okay, excellent.
we're gonna be 27% tech.
Yeah, just, what I would do is before you go right into the attributes, you kind of lay it out. You know, we're designing a portfolio of moderate to high returns with market level risk, okay? We are going to be investing and then go into the portfolio sector composition. And you could even mention some of the top holdings in your portfolio. I'm trying to give you the language, go ahead.
So we're gonna have a heavier cash position, just kind of where the,
No cash,
no cash?
no cash in the portfolio, fully vested. Fully invested in the market.
We don't wanna be fully vested with the current market conditions.
No, you are. Because I have portfolios I have to be fully invested in, it's a mandate. I don't want to be sitting in cash. Especially with the inflation rate at 2.5, I'm getting a negative real return of 2.5 right off the bat based on inflation. So I gotta get a portfolio of at least 2.5 to get a real return out of it. So I can't be in cash and getting negative returns. Ain't gonna happen. I gotta force you to be a stock picker. You gotta pick the sectors, you gotta pick the stocks. I don't care about the current environment because I get investors that are investing. If I'm a retiree, I'm investing for 20, 30 years. If I'm a pension fund in an institution, it's 30, 40 years. I don't care about, you know, mid-cycle corrections or any of that stuff. I'm looking at what are the best companies and the best sectors for the long run at the end. So try it again.
So I gotta change it. 'Cause
Okay, somebody else?
Ours are gonna be,
Our portfolio.
portfolio is heavily focused on tech, about 40%.
Give me the expected return and kind of the risk. That's like the first thing. Is it high risk, high return? Is it low risk, low return? Is it moderate return with moderate to high return with, you know, market risk?
Yeah, it's gonna be moderate risk, about moderate return.
Okay,
Heavily focused on tech with about 40%. We're also gonna include some health and pharmaceuticals, retail, and also a small component will be financial services.
excellent. That was perfect. How long did that take to do that?
To come up with that or to say that?
Both.
Well, about 30 minutes to come up with and about 30 seconds to say it.
Okay, so how many 30-minute time slots of available time did you have over the last 3 weeks to kind of put it together? So you had plenty of time to do it. It's just a matter of doing it, okay? And then trying it out, and then I can help you correct it, okay? It's one thing to say, okay, you know, I'm confused, I don't know what I'm doing. Well, ring Professor Souza, text. You know, you would have gotten the answer probably in 30 seconds. Okay? If you're confused, ask me. Do not sit around. What'll happen is you're gonna be at your job, you're gonna be confused, you're gonna be scared to go ask somebody for help because you think you're gonna embarrass yourself, you're gonna get fired. I promise. Because if you're sitting there not working because you're scared, you're gonna get fired, okay? You get up, you go ask the person, I really don't understand, okay? Can you explain it to me again? Great, let me explain it. Go back, try and do it. Once you've reached a certain milestone, show it to me, I'll give you some feedback, and we'll get you to completion. Okay? Just don't sit there. Don't do that. That's really self-destructive.
Is our back testing this?
Yeah, I'll walk through it again. Although, Albert was really cool. Albert said, oh, well, you know what I do is I just read the instructions. Right? And there's instructions all over the place. Okay. So I'll go through this again. Anybody want to try the portfolio?
We're gonna be really aggressive and only.
Okay, hold on.
invest in FANG stocks.
Hold on, tell me about the portfolio style. What is it?
Only invest in tech
No.
FANG stocks.
No, you gotta give me a big picture first.
Aggressive.
Our portfolio style is gonna be high risk, high return.
Our portfolio style. will be
This is
high
how
risk,
we are
high
gonna
return.
generate alpha.
Our portfolio style will be high risk, high return, only invested in FANG stocks.
In what?
FANG stocks.
Don't even know what that is.
Facebook, Apple, Netflix.
So it's tech.
Yeah, tech.
Okay, so in FANG, which I don't understand, usually what you need to do, because most people aren't gonna understand that stuff, so you need to say it and then give me the acronym,
Okay.
okay? What is FANG? I mean, what is this?
Facebook, Apple, Netflix, Google.
Okay, that's 4 stocks, so you're gonna have 40% of, basically you're gonna have
100% invested.
25%
$1
in
million
each stock.
split between 4 companies.
What? Ain't
Is
gonna
our
happen.
portfolio $1 million?
It has to be 25%.
invest all million?
No,
Because we can't have cash. Why
because
can't
you're not
we
going
do
through the
that?
process.
I don't understand first why. we can't
Build
have
a
cash.
tech portfolio.
Pardon?
Build a tech portfolio with a maximum constraint of any one stock having 8 to 10%. What you're doing is you're shortchanging the process. You're not even going through the process, which is extremely important to basically train your brain on how to construct portfolios. You're just saying 25% each. That doesn't do anything for me. You didn't use any kind of factor to come up with the 20%. It was just completely random. You didn't use any kind of factor weighting scheme such as market cap to come up with it, or sales, or revenue, or anything. You can't sell that. I won't buy it.
Okay.
That's not the company I have. I don't have a hedge fund where you can sell that kind of product to some ultra high net worth individual or somebody. I'm basically, I work for Schwab, I work for BlackRock, I work for JP Morgan. I build these products for the retail sector and the institutional sector. The more products I build and sell, I get more assets under management, we make more money, we're more profitable, we're all more profitable. I can't sell that.
So, I just have a question, why would I pay someone to manage my money when I could go put it in a very diversified ETF? I just think it's a little bit of an old model.
Because the world doesn't revolve around you.
I've never said it does.
I'm just telling you that we work as basically product managers for large institutional companies that design these products specifically for the retail and the institutional market. If you want to be your own trader and do your own thing, that's a whole different thing. I would go to Golden Gate and get a master's in technical securities analysis and go right to the fundamental securities analysis and go do that. But we here, I'm training you guys to go work for Schwab and JP Morgan and to go work in private equity, building portfolios on behalf of endowments, institutions, pension funds, high net worth individuals, ultra high net worth individuals in the retail market. Basically creating product lines and distributing products through our product distribution channels. So I'll walk you through this again. But come up with a portfolio. I don't care if it's tech, large cap tech, but give me 25 stocks with some kind of scaling factor that's going to scale the weights within the portfolio so that you'll not only get diversification to eliminate the unsystematic risk, but also see if you can beat the benchmark. See if you can beat the S&P 500. It's going to be hard. The S&P 500 year to date's up like, I don't know, after the last 2 days, probably, I don't know, 12%. Yeah, but the last 2 days it was down 6. Well, particularly in the Dow. Okay, you want to try again? Yes, sir.
Is the minimum percentage allocation to a single stock, you said 3%?
I set it at either 1 or 2%. And then I would not go above 10, and you can go as low as 8. And if you really want to push it, I'll let you go to 12, but you're going to have to tell me why you're over allocating the portfolio into one given stock, because as you start to overweight the portfolio into one given stock, the beta and the correlation start to converge to that company. And if that company is related to other companies within the sectors in your portfolio, you're not really getting diversification, you're getting concentration. Okay? And you better give me high alpha if you're going to start concentrating the portfolio. You're going to have to come up with a good story for that. Good questions. Somebody else? Yeah.
If you're investing in one company, like let's say if you're in, I don't know what it actually counts for, but like manufacturing, like you invest in Lockheed Martin, should you
Yeah,
also?
that's defense more than manufacturing.
Okay, so if you're investing in defense and you invest in Lockheed Martin, do you also invest in Northrop Grumman, or?
Yeah, if you're going to put together a defense component with an allocation, yes. You would put together the top 5, Boeing, Northrop Grumman, Lockheed, maybe 1 or 2 other companies. They're all going to be correlated together. They have similar betas.
Okay.
But you're going to be creating your allocation, not in one stock, but across 4.
Right.
So you're diversifying your unsystematic risk, okay? And you're exposing your systematic risk to that sector, to the overall market.
Okay.
That's how I would do it, okay? Anybody else? Yeah, go ahead. Yeah.
okay, I haven't even, seen
You still working on it? You guys figuring it out? Yeah,
Can you
go.
do, six sectors, or it has to be five?
No, I'm not making you do anything. It's just you can't invest in just 4 stocks.
Okay, well, I mean, we're gonna be semi-aggressive in our portfolio. We're gonna have 33% invested in tech, 9% invested in consumer staples, 20% in healthcare, 7% in energy, 18% in consumer cyclicals, and 13% in industrials.
Okay, that'd be cool. Yeah, that'll be good to see.
I would like to take out 5% of energy and put 5% in cash and only have 2% in energy.
No cash. You gotta be fully invested.
I don't understand why. I'm so curious. Why? Why can't
Because we have to be
any
fully invested. We have a mandate by our clients that we have to be fully invested at all times. It's really easy, isn't it, Jack, in the investment group, to go into cash and keep it in cash? And what was our opportunity cost by having the majority of our portfolio in cash for 2 years?
Loss of revenue.
Yeah, we lost out big time because we were in cash. It's easy to go into cash.
Yeah,
It's
but in
hard
the
to pick
investment group,
stocks.
you could barely get a trade
It's
done.
hard to pick stocks, okay? I'm forcing you to be fully invested. I don't make any money on cash. I'm getting a negative real return. I go into cash at a zero, but plus it costs me a fee to hold cash. And inflation's running at 2.5%, so my real rate of return on cash is negative 2.5%.
So then why do some of the biggest hedge funds and some of the biggest,
I don't care about those guys.
they have huge amounts of
I don't
cash?
care. We're fully invested. Okay?
What does that mean?
It means that all the stocks, all the money that I have is invested in stocks. It's always invested. I'm always looking for opportunities to buy and sell a stock.
So why would you hold cash?
Because he's precautionary. He's scared to be in the market because he thinks the market's got another second leg down. I actually look at the downside in the market as an opportunity to dollar cost average and actually pick up really good stocks cheaper than they otherwise would have been and were 2 weeks ago.
How do we buy if we don't have cash? We have to sell some and rebalance.
You have $1
the
million
portfolio.
bucks.
But if we spend it all and fully invested, I have $0 in cash, and now I have to sell some and have to rebalance.
Well,
my
that's not
portfolio.
the exercise we're doing here. The exercise we're doing here is to get fully invested and back test the portfolio and see how it did. See how it would have done over a 10-year period if you had selected these stocks 10 years ago and how they would have done. That's what we're trying to do.
I mean, the market, I think no matter what stock we pick, it would be up. The market's been crushing for 12, 11
Yeah,
years.
well, we should have gone back. I mean,
20
my
years.
models made more sense 5 years ago when I was looking at part of the trough. And now it's been 5 years later, I'm just looking at the recovery period. Maybe you should add another worksheet to the spreadsheet and do a 15 and a 20 and get it and see how your stocks really do. If your stocks go back that far, if you're gonna be that aggressive, a lot of those stocks never even existed 15, 20 years ago. So now you got a problem with the missing data. And you're gonna have to probably figure out a way to fill that data in to get a 15 and a 20-year back test. So those are some issues you get. Yes, sir. Oh yeah, I had 2 questions here. Go ahead.
I was just wondering, like, the theory on backtesting is that you're basically seeing what the stock did in the past, and that's gonna
The portfolio and the stock.
Okay, so everything's together, and then you're assuming that's gonna continue the trend at some amount in the future?
Yeah, and the qualification is, and I don't have the disclosure here, I probably should have the template disclosure on here that basically states that these are just back tests and that historical performance has no relationship to future performance. Therefore, I am not liable if the portfolio doesn't perform. But the best thing that I can do is I can back test and I can do the forward tests, over the semester to be able to stress test the portfolio to see not only how it back tested, but does it continue to outperform the benchmark? 1 month, 2 month, 3 months in. It's the best that you can do. If you look at the ETF worksheets from iShares, Vanguard, Franklin, all those companies, they give you 1, 3, 5, 10-year back tests. That's as far back as they go. It's the only thing that you have to be able to assess the portfolio to see if it could actually perform in the future, if you assume that the future is related to the past. Now, I could do if I was, if we were doing advanced class, we would do scenario analysis and stress test the portfolio under recession scenarios, which is probably what we should do, but we don't have time. or you stress tested on, now we're just looking at recovery periods, right? You'd go back over recovery periods if you have enough historical data for the individual stocks that you pick. But a lot of you guys are all in tech, so you're not gonna have a lot of historical data, especially if you're going mid-cap, small cap. Especially if you go small cap, you're not gonna have a lot of years of data, particularly for Facebook and, you know, eBay's been around long enough, but, you know, Uber and those companies, you're not gonna have any historical. That's why what you would have to do is run a correlation on stock price movement with the other companies and see if there's a correlation, then use the correlation to basically fill in the history to at least have something, and that's what we'll probably do on the second portfolio when we do the optimization, because we need 5 years of daily data. And we might have to run the regressions, and we might have to basically backfill the historical data on some of those stocks so we have a huge data set to run the optimization. Okay. I have a question here, there, and then you.
Can we just have like what our portfolios do?
Okay, go for it.
We said we're constructing a 60% tech heavy
Oh,
portfolio.
give me an idea of the risk return. Is it
high
high,
risk? High risk.
high risk, and what's your expected return?
Um,
Hopefully it's high return, because
Yeah,
I'm not
high
gonna buy a high risk portfolio.
Yeah.
That doesn't give me high return, okay?
so high risk, high return, and we said we're constructing a 60% tech heavy portfolio spread across defense tech, consumer tech, and medical tech, and equally distributed to 20% energy and 20% manufacturing.
Is it all large cap, or are you doing mid
Large
cap,
cap.
small cap? All large cap?
Yeah.
Okay, you're good.
Much of the question about our holdings, can we invest in commodities or no?
No, it's gotta be equities. Okay. Equities don't, they don't produce a dividend, and it doesn't, we're not using the intrinsic valuation model for commodities. You'd have to use supply-demand analysis and probably econometrics to be able to forecast, you know, what the value of the commodity prices are gonna be in the future. They're highly volatile, and you have to do more commodity-based research, and that's not what this class is about. Okay. Although I'll do some commodity supply-demand analysis later to get into it. But if you do go out and build portfolios, if it's a multi-asset portfolio, you could be doing stocks, bonds, real estate securities, and then commodities, and cash could be your portfolio composition on a multi-asset portfolio style. We're just doing equity portfolios.
What would be the pros and cons of making like a strictly dividend, high yielding dividend portfolio?
You're not gonna get, the portfolio is probably gonna have a low beta, okay? Probably converge to 1. Your returns, particularly capital appreciation on the stock price, is gonna be lower because there's gonna be low volatility, because the majority of, or a significant portion of the total return is coming from dividend yield or income return as opposed to capital appreciation. Those companies don't plow back all of their earnings into retained earnings to use in the company to grow. They've reached kind of the maximum growth potential, so they start to distribute the earnings as dividends to the shareholders to get the stock price to go up through dividend distributions as opposed to plowback into the company for growth. That's why the tech companies grow faster, because a lot of them don't pay dividends. They plow back all of their earnings, and they're burning through a ton of cash to either scale into markets or develop new products and distribute, or to develop new services and distribute. So they're all into the scale.
So then maybe would it be good if we're organizing this for like retail investors, for people to, they could live off of it for their retirement?
Yeah, that'd be cool.
Because then they could live off.
It's
of
gonna be
the
hard to
dividend.
beat the benchmark, but I could still, if you can get me an 8% rate of return and the market's done 22, I don't care, because me as a retail investor that's risk averse, I'll take an 8 because I can double my money in less than 10 years.
Yeah.
But if you can show me a lower beta or a lower standard deviation than the market, I'll buy it. Because I'm getting I can double my money, I'm hitting my expected return, and you're giving me a portfolio with significantly lower risk than the market.
Yeah.
And I would rather take half the market, you know, at significantly less risk, than to get the 22% in the market and take the volatility. I mean, a lot of retail investors right now are not comfortable being in the stock market, after what's happened over the last 2 days. So they're gonna be looking for a defensive portfolio like yours. We can totally sell that. Based on the volatility over the last 2 days and looking at a potential recession within the next 24 months, we've designed a risk-averse portfolio that is perfect for a risk-averse investor that's looking for their target returns, but significantly reducing the market risk. Okay? Okay. Who else? Yes, sir.
When you talk about correlating a newer stock to an older one,
Yeah,
so like if you want to see how Uber, I guess, was performing in the back test,
how it would have.
how it would have,
Yeah.
would you compare it to like Microsoft or something?
What you would do is you could just take, you could just take the stocks, right, over time, so they're gonna all move together, right? And I would look at Apple, Alphabet, Amazon, look at the top companies by market cap. Because all companies are correlated to the top companies in their sectors. So you have the stock prices, run the correlations, and find the one that has the highest correlation with that stock. And it should be one in the same sector, or it's gonna be an industry-leading stock. Okay? And we know that if Apple sneezes, the whole market goes down. Because the market cap of Apple is so big, along with Alphabet, along with Microsoft, along with Google, that movements of the top 5 tech companies in the indices are gonna move the indices and are gonna move the industry. Did that answer your question?
Yes, thank you.
And that's how you would do it.
Okay.
And once you run the correlation, then you can use the correlation coefficient to multiply against the dominant company, and then calculate the stock price.
Yeah, okay.
So it'll calculate the stock price for you by the share of the correlation. Okay, anybody else? Okay. Yeah,
When you say benchmark, are you,
the S&P 500, the NASDAQ, the New York Stock Exchange.
is that the same thing as a beta?
When you run the regression on the returns of your stock in the benchmark, it's gonna kick out the beta. Okay, so the more correlated it is, the higher the beta. If the returns move more than the benchmark, the beta is greater than 1. If it moves with the market, it's 1. If it moves less than the market, it's less than 1. There are really not a lot of stocks with really high betas. You have to be significantly over leveraged or in the tech space. I've never ever seen, really, but I've seen it just by running the calculations, because statistics are statistics. I've seen some stocks that had negative beta, but I don't believe it. Because if the market goes down, all stocks are gonna go down. Okay, so the beta, most betas will probably, if you look at the distribution, are probably 0.25 at the low end, and probably at the high end are probably 2. Around 2. But most of them, all the betas that I've seen, and most of the stocks from my classes are probably 0.8 to 1.25. It's kind of the range. And sometimes what I'll do is I'll plug in the beta, because the calculated beta is wrong. It's not the true beta, it's just a statistical aberration. Okay. Any other questions? Okay. So let me go through this again, one more time. Master target portfolio. Got it? Okay. First thing I would do, put your stocks in and basically segregate them by sector. Okay? So we can see very quickly what the sectors are. And here's the SIC or the NICS codes, or the next North American Industrial Classification codes, and the companies are grouped by sector. Okay? Then you have your tickers here. This is the stock price as of January 1st. Okay? Then over here, you're going to go to the, that's not it.
You said for the stock price, you put it for what was that?
January 1st.
Okay, cool.
Yeah, you want to put it right here.
Cool.
So you just hard code in the stock price as of January 1st. Because what we're going to do is we're right here, there's a forward test. Okay? And we're going to start forward testing the portfolio. So this one would be, what I would do is do this as of today. Okay? So in the master target that's January, this is as of today. So where are we now? We're, what is it, February 28th? So basically we're, almost 8 weeks, into the quarter. So we're 8 weeks in. So I could put in today's stock price. Could I calculate the rate of return on the S&P 500 for the last 8 weeks? Can I take the percentage change? Can I take the percentage change of the S&P 500 index and get a percentage change?
Yeah.
Yeah. And could I put that percentage change in right here? And if I put in the February numbers, this should calculate the total return on the portfolio year to date. And if I subtract the S&P 500 by the total return on my portfolio, can I calculate the alpha? And if I'm generating alpha, and I've generated alpha in the past, do you think my portfolio is going to generate alpha in the future? Yeah, and then you test it again. Front test 2, front test 3. Okay? So throughout the semester, you're testing your portfolio to see if it's tracking, if your alpha's tracking. Okay? This is a very simple portfolio. It is a fairly simple portfolio exercise too. Okay. Once you get it, your brain's gonna be wired as a portfolio manager. That's why we're doing it. Okay. So for the master target, we got the January numbers in here. What we are doing is we are building a factor model. Okay. A factor weighted model. Factor tilting. We are tilting the factors. We are tilting the weights to some factor. I just happened to pick the equity market cap. Okay? I could have used the total market cap, which was the total market value of the debt and the equity combined. I could have used total sales. I could have used total revenues. I could have used, most of these companies are international companies, so I basically could have put in their international sales as a weighting factor to tilt the factor weightings of the portfolio towards what companies are more export-oriented. That could be another factor that I could use. There are companies all over the place. Every single day, they're coming out with new exchange-traded funds based on factor tilting to basically create smart beta products that basically tilt the portfolio by unique factors to differentiate the product from other ETFs in the space, which there's a lot. And if the portfolio can outperform the benchmark consistently over time, people are going to buy into it, and you're going to get assets under management, you're going to charge a fee, you're going to get gross fee revenue, minus out all your expenses. We pay off our broker-dealer for holding our group, and then basically you, me, we basically get paid a salary. We get performance bonuses, and we get assets under management bonuses, and we get new product launch bonuses too. So there's a series of ways that we're going to be compensated based on your ability to create new product and distribute it, and get assets under management. Yes, sir.
So you're basically like creating ETFs or
Yep.
portfolios, and then
Yep.
how do you like popularize them to like have people actually invest in them?
Well, we can white label it, which basically means that we provide the portfolio strategy to AllianceBernstein. And AllianceBernstein will basically take our product with some coaching from us and put together a marketing campaign and basically notify all the registered investment advisors, which there's thousands, that we have a new product that we just launched. And they'll love it because now they have something that they can push their clients and sell their clients the new products. So we can use AllianceBernstein's branding and marketing and distribution channels. We just provide the product. Or Derivative Trading Corporation, DTC, which is our company, it could be a DTC product too. and brand it and distribute it through our networks if we want to. I really don't care if it's us or them. We're financial engineers, we build product. The more products we build, the more profitable we are, the better off we'll be. Because we're creative. We're not selling pre-product, pre-manufactured product. We're hired to design the product. We're the creators, we're the financial engineers. Okay. Any other questions? Okay, most people use market cap. I haven't seen anybody be creative and use any other kind of factors to create, a smart beta product. But if you want to do it, just use market cap or revenue or sales, I don't care. The weights are basically going to be the same.
Can you explain what is the advantage of using a different balancing thing for different data?
Yeah, because everybody uses a market cap weighted weighting strategy, so there's a lot of products out there that are probably competing with us. So the way that you differentiate is going to be, the stocks that you pick, sector allocations that you choose, and also the weighting factors that you use to weight.
Does that affect return?
Yes, it affects the risk and return of the portfolio. So imagine, I'm building all consumer-based products across different consumer-based industries. It's a consumer-based portfolio, which is a good portfolio if we're going into a recession. And huge volatility because people need paper towels, they need toilet paper, they need Clorox, they need toilet bowl cleaner, they need that stuff. They're going to continue to buy that stuff even if we go into a recession. But are you going to keep your Netflix subscription, or your Xfinity, $200 a month, if you lose your job for the next 6 months? No, you're probably going to use Hulu and some other type of online free access to entertainment. You're going to get rid of Xfinity because you can't afford to pay the $200 a month. So yeah, the companies, sectors, and the factors and the factor tilting will determine the expected return on the portfolio and the risk over the investment horizon. Most investors hold their stocks on average for 7 years. Most institutional investors buy and hold their portfolios for 20, 30 years because they have longer liabilities. And if you can build a portfolio that people can buy and hold, they just become money machines for people. And they'll love you. And they'll come back and buy more of your product. Okay? All right, so here you put in the market caps. What's the most recent audited financial data that you have? What's the most recent audited financial statements that you have?
2019?
Yeah, in 2019. So you can use 2019 factors. I wouldn't use quarterly numbers because it's too volatile. I would use audited. Well, what's the problem with using those? Those are historical cost numbers. So you can use current market cap if you want to. You can use average market cap if you want to. You can use total revenue, total sales, total market cap, audited within their annual report or their 10K. You can use that too. Or you can be creative and dig into their financials and find the amount of revenue that's being generated from exports. If you want to, or maybe since the global economy is going into a recession faster than the United States, maybe you want to look at multinational corporations and maybe focus more on domestic companies as opposed to companies with international exposures, because their revenues are going to shrink a lot faster than domestically here. And you don't have currency fluctuation issues that you have to deal with too. But I think the export sales is a really good factor because companies who export and generate revenues exporting to the world usually grow at a faster rate.
Would you mind explaining market cap simply?
Stock prices times the shares outstanding is the market capitalization of the company. So that's the value of the stock. If that's the value of the equity, you can take the bonds outstanding and multiply them by the bonds to get the market value of the debt. So when you put market cap the market capitalization, you could be using the market value of the debt and the equity, or just the market value of the equity. What's gonna happen is, the first thing you need to do is put the market caps in here and look at the weights and see what's happening. Because what's gonna happen is, if you have a tech-dominated portfolio, the majority of the weight's gonna go to Apple and Alphabet and Amazon, and those trillion-dollar companies are gonna get the majority of the portfolio weights. So what you end up doing, once you put them in, and you can see that you have some companies in here with really high weights, what you do is you manually start taking down their market caps. You start manually adjusting it. And what it'll do, the model will automatically redistribute what you took away from the large companies and distribute it to the small companies. So it all constantly always adds up to 100. So what you're gonna need to do is to go through iterations, manual iterations of the market caps, taking down the big companies first, and then bringing up some of the small companies that aren't getting any weights. So what I did in this situation is we took down the big companies because we wanted to max out the exposure in the portfolio and give no stock more than 9% of the portfolio. And what we did was we took up the market caps for the small companies so that they would get at least 2% minimum exposure within the portfolio. It doesn't make sense for you to have a zero stock allocation in your portfolio, because why is the stock even in here if you're investing nothing in it? That doesn't make sense. They're gonna ask you. So that's the first thing I do. Get the companies, segment them by sector, get the tickers, put the January numbers in, put in the market caps, and then adjust them. If you want to set a minimum max, you can do that by taking down the large market caps, bringing up the small caps. You can go right to the minimum maximum set on your portfolio, or you do what you were talking about. I just want to let it run. I'm going to have an unconstrained portfolio, and basically 25% of my portfolio is going to be an Apple. But you can't sell that. Nobody's going to buy this portfolio. So it doesn't work. We are looking to sell this product to the broadest market. We want to do mutual funds, ETFs, single accounts with CalPERS, where they're giving us $2 billion to replicate this portfolio in their single account. That's what we're trying to do. Okay? All right, everybody clear? All right. So then, I'm sorry. And then over here, on the side of this portfolio, what they did, they calculated the weighted beta, which is this, and they actually calculated the weight of the portfolio by market cap by the individual sectors. You're going to need that stuff for your presentation. Okay? All right. So then the 1 year, January 2019, boom, done. Okay, but you're going to have to calculate the 1 year from January to January return on the S&P 500, put it in there. So it's going to calculate the 1 year S&P alpha. Okay. Everybody clear? Everybody clear? You understand? I want to make sure. Then what you do is you go back 3 years. Boom. Put in, what are we, 19, 18, 17? January 2017. January 2017. Okay. And then you got to calculate the average annual compound growth rate for the S&P 500. I'm not sure everybody knows how to calculate the average annual compound growth rate. No, you plugged it. I'll have to show you. I actually have formulas in here. And then for the 5 year, what is it? 20, 19, 18, 17, 16, 15, wait, 20, 19, 18, 17, 16, 15. January 2015. 10-year. January 2010. Boom. So what the portfolio does, and I'm kind of cheating a little bit on this, I admit my mistakes and I admit my flaws. But what we took these percentages right here. I've got the target portfolio worksheet here. So once I got my weights, I multiplied, let's see, what's this, money center banks, it's 4% of the portfolio. So basically what I did was I multiplied 4% by the 1 million to get 42,154. Divided it by the current stock price as of January to get the number of shares. And then what I said is, okay, those are the number of shares. So what would be the return if I bought these numbers of shares and the shares didn't change 10 years ago, 5 years ago, 3 years ago, 1 year ago? I'm supposed to be doing, asset rebalancing, to these portfolios over time. That's another class. That's more complicated. This gives me some quick and dirty back testing without having to go through the rebalancing. Okay. So it's simple, but it's good enough for the exercise for this course. Okay. And if you want to do the rebalancing and stuff, maybe you work with me and you build another program for my class, and then I can use it next semester if you want a program. Okay, let's do the S&P 500. Okay. So how do you calculate the return on the S&P 500? Did I already go over this? No. Okay. So you're going to need to calculate the average annual compound growth rate for the S&P 500 over a 1, 3, 5, 10-year period. So this is how you calculate it. I should probably put this on the video. One of these days, one of my videos are going to go viral because everybody thinks I'm just so mean. Right? Because I'm so direct. It's just because I don't have a lot of time. I gotta be honest and direct. Okay, so this is what most people will do. Okay, so where's the S&P 500 right now? Or give it to me as of January. So 01, 2020. Where was the S&P 500?
3242.
What was it?
430.
What?
3242.
3242.
42. 0.43.
No, that's not right.
Wait.
3, 2, 7.
Okay, all right. 3, 2, 7,
8.
8.
2.
Oh, let's forget that. I don't need that stuff. Okay. So the S&P 500 index as of January 1st, 2020 was 3278. Got it? Right? Now give it to me for 3 years ago. January 2017.
2275.
2275?
Yeah.
Got it. Can I calculate a percentage change like this? Can I calculate it? Okay. So what is that percentage change? What does that come out to be? You guys need to watch this, because you're going to be doing calculations and stuff. Day one, when you sit down, at a company, if they're nice, they'll show you how to do it. If you walk in and know how to do it, you're in. Okay, you'll save them so much time. So what's the percentage change? Do you have a calculator?
44%.
What is it?
44%.
44%? Got it. And what was the time period?
3 years.
So what do you get? What's 44 divided by 3? What is it?
8.7%.
What is it? is not how you do it. Okay? I'm just showing you right now how you don't do it. Okay? Now I'm going to show you how you do it. All right? So let's do the 1 year first. So we know that as of January 1st, 2020, the index was 3278. And where was it as of January 2019?
2607.
What is it?
2607.
Is that right? Are you guys checking to make sure it's okay? I mean, I trust Albert, but he could be dyslexic or something, or maybe having a bad day. So, we need to just, and I have a little dyslexia, so. But no, what, can you double check it? Is that correct?
What'd you say?
3275 as of,
Yeah.
3278 as of January 1st, 2020, and 2607 as of January 2007. Got it. Okay, and then we go like this, 1 divided by 1. Okay. Minus 1. Minus 1 times 100. Got it. So what's this product right here? 25. No. Give me this ratio, because I got to show them how to do it.
Oh, the
1 point. Is it 1.25?
Yeah.
Yeah, so it's 1.25. I'm going to build on this equation.
1.257.
Yeah, so it's 1.26.
Yeah.
Just round it. Minus 1. Okay, so what's 1.26 minus 1? Okay, you guys got to watch this stuff. Okay, unless you already know this. Is what? 0.26. Got it. Times 100 equals what? 26%. Could I just, if I'm doing just a percentage change over within a 1 year period, can I just know this and this, divide this into this, come up with this, and know it's 26%, so I eliminate these 2 steps. So could I do that in my head? Yeah. In rough estimates, you could have done this in your head, and then maybe done an average or something if you did over years, just to get an approximation in your head. So doing math in your head is not really as hard as you think it is if you know some of the shortcuts. Okay? And that's one of the shortcuts. Now let's do the 3 year. Let's do 3 year return. So does the numerator change?
No.
No. Does the denominator change?
Yes.
Does the model structure change? Not really. Oh, yes. Got it. And you know it's 3278. Got it. And we know that the benchmark index was 2275. Got it. And then what's 3278 divided by 2275? What? 1.44. Okay. And we know that 1 divided by 3 is what? 0.33. Something like that. 0.333333 out to infinity. So what do you get if you take 1.44 to the 0.33? Can you guys all do that? Do you have calculators and stuff to do that? Do you know how to work with your calculator? That doesn't sound right. So what's 1.44 to the 0.33 power? The exponential.
2.
What is it?
2. I might be wrong.
What is it? What is it? 1.13 minus 1. 1.13 times 100. Did you guys check that? Are you guys double checking the numbers? Because you're going to put them into the report, and if you calculated them wrong, or I calculated them wrong, they're all going to be wrong. Right? So So is everybody checking and verifying everything? Yes, no, yes, no, yes.
Sorry to go back, but I was just wondering that 2607 again, where did that come from again?
This was as of 01/01/2019, S&P 500, the index.
Thank you.
Is that
The number on
correct?
top was 01/01/2020.
Say that again.
The number on top, 3278, was 2020, where the S&P was at 2020.
01/01/2020. Okay. Everybody clear on how to calculate average annual compound growth rates? Now let's do the 5-year. Okay. Same structure. Can I program this in Excel?
Yes.
Could I put that in that cell right there on the 3-year, the 5-year, and the 10-year? Could I program it and just put in the index levels and it calculates it by itself? You guys probably want to do that. So where was the S&P 500 index as of January 2015?
2028.
What is it?
2028.
Got it. Okay, and what's this equation right here? What's the ratio right here? What's this ratio? 1.61. And what's 1 divided by 5? 0.17 or something like that. 1.6.
1.2.
1.2.
Yes.
0.2 something,
No, just 0.2.
or the 5? Okay. So what's 1.61 to the 0.2 exponential? What is it? 1.10 minus 1. 1.10 times 100 is 10%. Right? Yes.
What is the 2275?
This is the S&P 500 index as of 01/01/2017.
Thank you.
And this was the same, this was as 01/01/2015. So what we're doing right now is we're calculating the benchmark returns to compare against our portfolio to calculate the alpha. And if we get an alpha, we're going to get assets under management, because if you can beat the benchmark consistently over time, you win. Period. Okay? And you don't even need to beat the benchmark consistently over time, as long as you can get your clients an 8 to 10% rate of return. And they'll even take an even lower rate of return if you can collapse the volatility and the risk. Okay? Because I've got clients that are super ultra conservative that don't want to lose any money, and they would take a 5% rate of return with zero or like a minuscule volatility. So you're really pushing down the risk. And they'll take 5% for no risk or little risk.
So if you go, like, if we were to like make a portfolio with all the stocks that we just built up, and then we like found that the risk was lower or higher than we wanted it to be.
Most people aren't concerned about the risk when you're building these portfolios with these companies. What they're more concerned about is reaching the 8 to 10, reaching or beating the benchmark.
Yeah. So then, if like it didn't reach or beat the benchmark,
But if my beta was 0.25, I would take it. So if you can give me an 8%, the market's done 22, under extremely over-accommodated monetary policy, which I know is not going to, happen in the future. Plus the S&P are the top 500 companies. So anybody who has anybody that's using margin or using, they're gonna buy the S&P 500, so it's probably overinflated. But if I can get them an 8 to 10% rate of return, I can double the money under the rule of 72 in less than 10 years. If I can get them that and have a beta of 0.75, 0.2, 0.5, so I'm giving them a lower systematic risk. Yes, we're not beating the benchmark, but you can still double your money. But what I'm doing is I'm building a portfolio that's highly diversified. And I'm really cramming down the volatility and the risk in the portfolio. And I'm giving you an expected return that you need to be able to double your money. There's a couple ways to skin the cat on this, but it's really hard for me to sell a portfolio of low return and high risk. Can't do it. Doesn't make sense, right? Can't do it. Or a portfolio that has low return and market risk, can't sell it. Okay. I gotta provide a value proposition to the client. Okay.
Can you explain what the beta tells you? So you said a 0.25 beta would be?
Yeah. Let me do this one first.
Sure,
How much
sure.
time do I have? Okay, let's just finish this. Okay, so we know that this is 32.7. So where was the S&P 500 as of January 1st, 2010?
1123.
1123, got it. So let's do this one. So what's 3278 divided by 1123? 2 point what? 2.92. Got it. And if you take it to 0.1, you guys gotta follow this stuff. This is the mathematics. I need you to burn this stuff into your brain. I can't have you walk into a job and you don't know this stuff. Okay? You gotta know this stuff. And nobody taught me this when I left college. They probably did, but I was probably thinking about something else. So luckily when I got there, you know, the managing director was nice enough to sit me down and not only teach me how to calculate this stuff, but also teach me how to write and do memos and do reports. They spent a lot of money on me, trying to remediate the lack of skills that I didn't develop when I was in college. Okay? So what's 2.91 to the 0.1? So 1.08, got it, minus 1. 0.08 times 100. So the average annual compound growth rate on the S&P 500, or the average annual compound return, or the average return, or the expected return for the S&P 500 over the last 10 years was 8%. Under the rule of 72, how long would it take me to double my money using the 5-year? 7.2 years. Under the 8%, under the rule of 72, how long would it take me to double my portfolio? Is that under the 10th? Is that under 10 years?
For that last one, I got 1.11 for the, for the power, for that, for instead of 1.08, 1.11.
You got one? Somebody double check
I
it
got
out.
1.11.
I also got.
So
Anybody else? Yep. So give me the, how long would it take me to double?
7 years.
What?
7 years.
Yes. So that's how you do it. And I would program it in your Excel. Okay. So that's all you have to do is, when you update the portfolio, you can just, in the future, if you ever use this again, you can just update the index levels. Okay, and I'll calculate it for you. Got it. What was your question again? About the data? Got it. So data and correlation are very similar to each other. So I'm putting together, here's the S&P 500. This is your benchmark. We're benchmarking the performance of our portfolio against the S&P 500. I could use other benchmarks, but this is the benchmark that most people use to benchmark their portfolios. Okay. This is the returns. These are the returns on the index. Now I could use quarterly returns. I could use year-over-year quarterly returns. I could use month-over-month annual returns. So I'm getting some kind of annual returns. Okay, so this is for the benchmark. Now for the company or the portfolio that you're looking at, does our stock and portfolio move with the market? Does it move exactly with the market? Yeah, so our beta is one. So if I ran a regression, the return on my stock against the benchmark is going to kick out the beta coefficient. What about if the return on the stock is like this? What would be my beta? Is it moving more or less than the market? What would be my beta? Point? Well, it's not half. Maybe like 0.75, something like that. What if the what if it moves like this? Negative. This is very rare, if ever. Most stocks are like this. Like I was saying earlier, when you run the regression, maybe a statistical apparition, you're calculating the calculated beta based on the sample. You're not calculating the true data. So you have to go back and look at what the true data and maybe even adjust it based on what you think the data actually should be. Most betas that I've seen probably are as low as 1.45 to 1.5. And the highest beta is probably about 2.0, but the theory is that as companies become big, Apple, Alphabet, Amazon, those companies, and they come to dominate basically benchmarks, that as these companies become big, they start to reflect the economy, they start to reflect the stock market, therefore their betas start to approach working, just my luck, pitch, trying to close. So basically company betas converge to one, okay, over time as they become one. If they're entered into the benchmark, which all of them have been, they basically become the benchmark. Okay. So high betas, am I out of time? So I'm looking at stocks. I'm looking at the expected return on the stock. I'm going to use the capital asset pricing model. Risk-free rate, the beta, minus the return on the market, minus the risk-free rate. If I'm looking at a company with a high beta, what's my expected return going to be? The beta is low, what's my expected return? And then this becomes this. This flows right into the flows right into the valuation model. So I'm looking at a company with a high beta that's going to increase the expected return, which means that the valuation could be compromised if the beta is going up. But if I'm buying a high beta stock, this is probably going to be really high, which means that the intrinsic value of the stock is going to be high. So the higher the beta, the higher the risk, the higher the growth prospects for the future cash flows for the company. So I want to be compensated. Okay. Any other questions? You guys got all that? You know what to do. You know, portfolio, you're in. Okay. Memos, can we do memos? Yes? Oh, shit, are you in this class?
Yeah, I don't care. I was like, I'm not gonna answer. Here I am.
No, just don't do that. I'll go. I just need to get everything done. I'll give you one.
Do we have group members?
Yeah.
You also. No, we don't.
I'm gonna take some.
Just make a whole nother thing.